What will stop the Fed? Hi, everyone. Welcome to the Real Vision Daily Briefing and Happy New Year to all of you. With me today is Darius Dale, founder of 42 Macro. Hi, Darius. Happy New Year.
Happy New Year, Maggie. It's great to be back. It's great to be back with the Real Vision gang. So appreciate being here.
Yeah, I think we're feeling hopeful, but let's see what happens because 2022 really knocked the stuffing out of a lot of people. But listen, we're 2 days into the trading year. We had a down day for U.S. stocks yesterday. Not a great way to start. Rebound today. Just broadly, how are you feeling about the markets as we start this new year?
Well, great question. I'll answer not the question you asked, but the question that I want to answer,
Sure.
which is I don't really feel anything about the markets. As you know, we run a pretty systematic quantitative process here, 42 macros. So the summary of those processes leads me to continue to be bearish. I mean, as you know, I've been on this program for quite some time, espousing our bearish bias on risk assets and really, in the back half of last year on bonds as well. It's been pretty brutal out there for the past 14 months since we made that pivot. And ultimately, we still think we're, at the earliest, or sorry, at the latest, maybe in inning six of this bear
Mm,
market. At the earliest, probably still inning four, 4.5.
yeah, that's making me grimace to hear that, but it is consistent. I know with what we were talking about
Sorry, I'm
last
not
year, and
trying
I
to scare
laughed.
people in
Yeah,
January. I know everyone's
bum
coming
us
back
out.
from
That's all right,
vacation and
Gary.
holidays.
Information is power, right? Like we can, all of us have to sort of just like try to do what we can in this environment. And I'm laughing because right before we came on, I was in the chat and I asked, "How's everybody feeling?" And JC said, "Cautiously pessimistic," which I think is kind of like sums up
That's
what
what
a
bear
lot of
markets
us
will
are
do to you.
feeling. So thank you for that, JC. And just a reminder, if you have any questions, comments, just go ahead and put them in the comment section of our website, in the chat on YouTube, or you can tweet us at Real Vision, and we'll try to get to as many as we can. We love hearing from you. So, Darius, the Fed seems like it looms large again. We got the minutes out from December, gave us a little bit of insight into what they were thinking when they decided to go from 75 basis point hikes to 50. Anything in there that stood out to you?
Yeah, no, this is one of those rare days where the Fed minutes are an actual market moving catalyst. From my perspective, I think there's three main things that I saw in there that pretty much affirm what we've been talking about over the past few weeks at 42 Macro, which is this very underreported hawkish Fed pivot. The Fed pivoted in December, on December 14th, to an incrementally hawkish posture. And that part of that pivot is really twofold. One, the obvious cohesion amongst committee members with respect to their dot plot forecasting, both on the policy rate side, but also on the econometric side as well. And then obviously upgrading the labor market in their reaction function and downgrading inflation, which means they're going to be at this policy tightening regime for longer. So going back to the respect to the Fed minutes, there was really three things in there that really caught my attention, which is, kind of one was a real shot across the bow back at us market participants, which is, an unwarranted easing of financial conditions, especially driven by a misconception, a misperception by the public of the committee's reaction function, dot, 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 basically telling us, look, you guys think we're, going to be easier than we continue to, espouse with respect to our forecast. We're going to be aggressively pushing back against that all year. Number two, they continue to highlight the fact that their dot plot estimates, again, which there's a significant amount of cohesion, a very significant lack of dispersion amongst the forecast for the dots are likely to, for the Fed funds rates likely to end 2023. They basically called out the fact that those dot plots, that lack of cohesion, or sorry, that lack of dispersion and the dots at 5.1% per year in 2023 is significantly and notably above market-based policy rate expectations. So again, pushing directly back against the markets who are already starting to implicitly price in this Fed pivot. Not implicitly, it's very explicit at this point if you look at Fed funds futures and euro dollars. And then lastly, just kind of doubling down on what Powell doubled down on in the policy in the press conference on the 14th, which is the fact that the labor market remains out of balance and extremely tight. So that, from my perspective, I think it just confirms the fact that we thought the Fed pivoted hawkishly, and I think the rest of the market's kind of getting that memo today.
Wow. So I think that's what you said, that upgrading the labor market, downgrading inflation. What do you mean by that? That seems very important.
Yeah, so that's a extremely important phenomenon because what it ultimately means is that the Fed is going to be in what we call this phase one liquidity cycle downturn. For those of you who are new to the show or new to how we think about this bear market at 42 macro, we've been thinking about recessionary bear markets, of which this one is likely to be a recessionary bear market. They always have two phases. The first phase is what we call the liquidity cycle downturn, effectively where the Fed and other global central banks are removing the punch bowl to combat inflation. The second phase of the bear market, and the one we have yet to even begin pricing in at all, in our opinion, at least not in the opinion of the data, rather, is the phase two credit cycle portion. The phase two credit cycle portion is obviously function of declining earnings, declining cash flows, and ultimately rising credit risk that you typically see in the market. But the issue with respect to the Fed upgrading in the labor market is always the last thing to break in the business cycle. You have times in various business cycles where you could see inflation dissipate in advance of recession, particularly from a headline perspective. You tend not to see a significant breakdown in core inflation outside of recessionary conditions. And so that's one thing that's ahead of us there. As it relates to the labor market, I actually sent a few charts to you, Brian. If you don't mind, put them up, starting with the slide 19, which is the first chart. Again, these charts came from our December macro scouting report, which was effectively presaging everything we heard out of Jay Powell and the FOMC in December, and obviously today with these Fed minutes. So starting with chart 19, we show that the post-COVID reduction in labor supply appears permanent. And what I mean by that is that we've seen this pretty significant decline in the labor force, particularly from a labor force participation rate perspective, which is the first panel in this chart. Whether you look at slice and dice it across different cohorts, which is labor force participation rate for 55-year-olds plus for women and for the prime working age population, which is 25 to 54-year-olds. And as you can see, on an aggregate basis, you're down about 130 basis points from the perspective of the labor force. The Fed's own estimates suggest that the labor force is about 3 million people shy of where it should be. We've done the math, and it looks like it's closer to 5 or 6 million people where it should be relative to the pre-COVID trend and the trend that we've established in the post-GFC era. So somewhere between 3 and 6 million people are effectively vanished from the labor force. I have a bunch of hypotheses on that, but I don't think it's an appropriate medium for that because it could take up the whole show. The second chart, which is Brian on slide 20, where we show the demand for labor is proving resilient. And what I mean by the demand for labor is proving resilient, we continue to see job growth and really more importantly, aggregate labor income with respect to the private sector. The chart on the left just shows our measure of private sector labor income, which is the fourth cluster of bars there at 6.6%, which itself is the productization of the growth in total employment, the growth in average hourly earnings, and ultimately the growth in weekly hours worked. And I know there's a kind of zero hedge-esque view out there that the total employment hasn't really grown in the last kind of 6 to 9 months. So what we're taking there in terms of total employment growth is just the mean of the household and establishment surveys to tip our caps to both the economic bulls and the economic bears. But I don't even think that matters. If you turn your attention to the chart on the right, the first cluster of bars shows the nominal employee compensation data that we get out of the BEA in conjunction with the PCE report. And as you can see on a 3-month annualized rate of change basis as well, that's accelerating to 6.1%. So no matter how you slice or dice it, the total amount of income us consumers are receiving from the labor market, particularly from the private sector side of the labor market, of which it's the lion's share of total employment, we're tracking around 6% or even north of 6%, which is basically a double relative to where we were in the pre-COVID trend. And then the last chart I'll highlight on this, Brian, is slide 21. We got this data out of the JOLTS report this morning. The first panel on this chart just shows total job openings divided by total unemployed workers in the U.S. at 1.7. That ratio is more than double the pre-COVID trend. So we got a problem. Sorry, roughly double the pre-COVID trend. So we got a problem there. It's really not budging. Certainly not at the speed that the Fed needs it to break down in order for it to receive, quote, substantially more evidence that inflation is returning back to, quote, their 2% target, which they continue to reiterate in the Fed minutes today. And then lastly, in terms of the data we got today, you got the quits rate data, which is the middle panel on this chart, ticks back up to 3% from 2.9%. Obviously, 3% is still well north of that pre-COVID trend. So it continues to tell you that this is a labor market that is either tight, very tight, extremely tight, out of whack, out of balance, like Powell's continued to cite, or it's actually getting more out of balance and more tight. And we can see that as evidenced by the bottom panel there, which is the employment cost index for the private sector. Data is a little bit lagged in terms of the 3Q, but on a quarter-over-quarter SAR basis, that's at 4.2%. That's a double the pre-COVID trend. So we got problems because, again, labor dynamics are running more hot than the inflation dynamics right now, and the Fed is pivoting its focus from inflation dynamics, which are starting to cool a little bit, particularly from a headline perspective, to things that are not cooling and are unlikely to cool unless we go into a recession.
Yeah, that answers the question we started the show with. What is it going to take for them to pause? And you're telling us, and they're telling us that it's the labor market. And interesting, when we were looking at your charts, when you're talking about the fact that demand is still resilient and the labor market's really tight, some people have been looking at that and saying, well, look at that. That means the economy's stronger than people think, and maybe all this talk of recession is overdone. But is it a kind of timing issue here? Is that true? Or is it just that they are going to go until they break the labor market, and that is when we will see some of the real pain?
That's exactly the problem. If this was a Federal Reserve that was comfortable with the pace of growth in the labor market from an aggregate income perspective, or was comfortable with the level of inflation that we continue to observe on a compounded basis, 3-month annualized, for instance, every single measure of underlying inflation, median CPI, trim mean CPI, sticky CPI, trim mean PCE, all those measures of underlying inflation are actually still tracking in the 5 to 7% range, 3-month annualized. If the Fed was comfortable with that, this would be, I mean, you wouldn't be able to buy enough stocks. You wouldn't be able to buy enough Bitcoin, crypto, or risk assets broadly because the Fed is effectively allowing nominal income, nominal GDP, nominal everything to go straight up through the roof. The problem from an asset market and capital allocator perspective is really twofold. One, the Fed is preventing that by tightening policy and continuing to drain the punch bowl, the gigantic punch bowl that they filled up, kind of in 2020 and 2021. So that's a problem in and of itself. But also a bigger problem is the fact that we continue to deal with, very robust valuations. This is a stock market, if you look at the S&P 500, that is still very overvalued on a price to next 12-month earnings basis or price to sales basis relative to any point in time in history where we had, policy rates in the 4s to 5% range. I mean, it's just preposterous how overvalued the market is relative to the cost of capital out there. So ultimately, we still think asset markets are in for a world of pain in 2023.
Yeah, and this is, if the Fed is going to have to keep being aggressive to get that labor market, and that's what they're focused on. I presume that's why you think we've got phase 2 to come, that credit deterioration and hit that you don't think has happened yet, right?
No, I mean, look, we talked about this on the program several times throughout the year, which is, there's a view, and I certainly tip my cap to Raul because he sort of altered this view going back to the summertime. I disagree with you respectfully, which is that the market had already priced in a recession. And I think he was using sort of the year-over-year rate of change of various market indicators relative to the PMIs, et cetera, et cetera. And that was correct. The market had priced in a low 40s PMI, and that's exactly where we're headed, obviously, looking at this morning's data. The problem is that that's the good side of the economy. The good sector is notoriously volatile. We're obviously dealing with the bullwhip effect from the pandemic stimulus and the reopening and all that stuff associated with it. And so we're now, kind of in a good cycle downturn globally. And we could see most major economies and PMIs in the 40s presaging, kind of negative industrial production growth in subsequent months. The problem, again, going back to the liquidity cycle downturn that we are still very much mired in, is that the services side of the economy in most developed economies, it's 90% of GDP, 90% of employment for the most part. The services side of the economy continues to run gangbusters. It's very hot. We continue to get data both from the labor market and otherwise that continues to support that. Hey, look, demand in the U.S. economy and demand abroad in a lot of these other economies that are struggling with well above trend core inflation is running too hot relative to the observed level of labor supply. Going back to that first chart we showed, slide 19, which is, look, we have a significant reduction in labor supply, so we need companies to stop trying to hire people. But guess what? I run a business. Raul runs a business. You want to make money when you run a business. So as long as you can finance yourself and try to expand, you're going to do that. And so ultimately, the Fed has to basically continue to roll up the newspaper and tap us on the nose like we're puppies and tell us to stop hiring. And ultimately, you're starting to see some cracks, Salesforce, for instance. But ultimately, we just haven't seen enough.
That Salesforce out now. No, but to your point, I mean, I think anecdotally, all of us feel it. Anybody who went out over the holidays, there's still not enough staff in restaurants. The demand is, and everyone's frustrated, but this is the worry, if you're a business owner, you can't say, well, I'm not going to service my customers because I think a recession's coming. You only can deal with what you can deal with in your reality and what you see. And that is that, people are lined up out the door waiting to get stuff. You bring up a really important point, I think, Darius, that this push and pull, though, between these camps about recession and really importantly inflation, and we hear it and we try to present all views so that people can hear both sides. And we do hear a really wide range of opinions from people coming on. One of them I spoke with recently, we had on air, is Ms. Schneider from Market Gauge, who really kind of gave voice to those who think and are concerned about inflation remaining elevated. Let's have a listen to that clip.
Well, there are certainly aspects of inflation that have probably peaked, because inflation was definitely something that was a bizarre event happening post-COVID, with the world finding itself with a shortage of labor, a shortage of supply chain issues, and essentially product, and particularly raw materials. But a lot of that, with the Fed tightening, has dissipated. However, the type of inflation that I expect to see in 2023 is going to be based on something very different. And it's going to be on more, I really sort of shudder to use the word chaos, but more chaotic situation, as sovereigns have to scramble to try to avoid deep recessions. We have geopolitical issues all around the world. And the central banks lost a lot of credibility this year because they tightened too fast, too late, and whether or not they pivot because they have to, and the decision they'll have to make. That's why we think basically what we're saying is we're looking for inflation in all the wrong places, and we think it can get really, really ugly in certain areas for 2023.
That full interview is available on our platform. Brian's going to drop a link in the chat on YouTube. If you want to hit it, you can get access to it. So, she's not the only one, Darius. And I think this idea, whether it's service led, whether it's coming from structural things happening in commodities. In fact, we had a comment or a question from one of our viewers right now, IR Impossible. So shortage of energy or labor equals need for hawkier Fed. I like that, IR, hawkier Fed. But that is the argument. But then on the other side, you have folks like Andreas Stano Larsen, who tweeted out just today, I think we can pull it up, European inflation peaked. And he's going to do a deep dive, by the way, into that view on his new show, which is debuting tomorrow, called Steno Signals. But there are people who are looking at things like that, looking at the IMS prices paid and saying, okay, I know it doesn't look like it now, but we are going to see this deceleration in inflation. How do we square these two camps when people feel so convicted about this?
Yeah, well, I think that the number one thing we're all learning, not we are all learning, because I've known this for a while, but I think a lot of investors are learning, is that inflation is not this monolithic basket. We can treat it like a monolithic basket when inflation's, at the target around 2%, and it, goes from 1 to 3 basically in these cycles. But now we're going from 0 to 10, and there's a lot more fluctuation, a lot more puts and takes. I think the Fed has done an excellent job this year, or in this past year, of really kind of helping investors, helping the market participants like myself really focus on what they care about and their reaction function with respect to their guidance. I mean, Jay Powell's been extremely explicit all year about the things that the Fed cares about and the things that the Fed doesn't care about. For instance, like rent and rental inflation, et cetera, et cetera. Or year-over-year time series at this point. It's kind of noise at this point. The Fed has been very explicit about being concerned about the labor market and how that's contributing to services sector inflation. Again, we got services. They're one of their preferred metrics, or one of their elevated metrics in this recent hawkish pivot, going back to early December, is this core services PCE inflation. If you subtract housing out of that metric, and we're still compounding at 5.6% on a 3-month annualized basis. Like everyone keeps talking about, the base effects are going to drive inflation down. The base effects are going to drive inflation down. Guess what? The base effects aren't going to do jack. For lack of a better word, poop.
Yeah.
If you keep compounding sequentially at the level that could create 5.6% inflation, and that is the problem. It's because the labor market is too tight, nominal income growth is too high, and companies have too much cash, and they keep trying to expand, and that's an issue.
I want to get a reaction to a couple of other things that were tweeted out by some friends of the show as well. One of them was Jim Bianco, who was pointing out just at the start of the year, if you look at nominal bond returns for last year, I think he said it was the worst in 230 years. We know bonds were a big issue and a real source of pain for people last year. Is it safe to go back in the water? Does it feel like 2023 is, I don't know if I want to say a better year, but a return to something that looks more familiar to people?
So our answer to that question has been pretty consistent for the past few months, really throughout the second half of the year. which is, as long as we are stuck in this phase one liquidity cycle downturn, bonds are not, they're a sell.
Mm.
At the bare minimum, they're not a buy until you get a lot closer, until the market is comfortable beginning to price in that phase two credit cycle downturn. If we've talked about this in the program, it's our belief that U.S. economy has some juice. It's got some resiliency to it, as obviously evidenced by the the uptick in GDP that we saw in the second half of the year, but more importantly by this continued thrust in income growth. You have nominal and real income growth accelerating right now, and in an economy that has two-thirds that's two-thirds consumption, or really roughly 70% consumption. That's an issue from the perspective of the resiliency of the economy and contributing to resilient inflation. So ultimately, we do believe that bonds are a buy at some point in 2023. It just might be a buy from a lower price at a higher yield, just given the fact that we got a tremendous amount of supply coming on, both from the sovereigns themselves, but also from foreign central bank, or from central bank balance sheets. And ultimately, you might have to get wade through that murky water as a fixed income investor in the first part of this year, because again, why would you rally a bond if the Fed is telling you they're not going to cut interest rates for, by their standards, a really long period of time heading into an economic downturn, if they're still going to be, dumping supply on the market? I just think it's a very, I don't know, arrogant trade, for lack of a better word.
I think this is really important. This is where you really need to listen to the camps and kind of look at your own viewpoint and your time horizon and figure out if it makes sense. Because I heard a bunch of people on TV today recommending bonds, and I was like, that's a big call. Wait a minute. Let me think about this. Trevor L asking, when are you going to go risk on, Darius? Not until 2024, question mark. I already know the answer to this. It's probably when your indicators tell you, right?
Yeah, no, I mean, look, when you're trying to time the bottom bear market, we've done extensive research on this subject matter. There've been 17 bear markets in the past 100 years, beginning with Act One of the Great Depression. And on a median basis, they bottom, they inflect when the Fed inflects. And so you're talking about a Fed that's likely to pivot at some point in time in the second half of this year. Now, will we be at the bottom of the credit cycle downturn at that particular juncture? Maybe, maybe not. I think you need to be, you don't have to be, sorry, you don't have to be at the bottom of the credit cycle downturn, but you certainly need to be well on the way to pricing one in. And if we're not well on the way to pricing one in, then I'm not so sure the markets are going to bottom. This will look a lot more like 2007 to 2009, or 2000 to 2002, really 2003, if you think about the March retest. So there's two types of bear markets. There's one where the Fed panics and the market keeps going down. And there's most of the time, however, on a median basis, going back to that sample, the markets tend to bottom coincident or shortly after the Fed, inflects its reaction function. So it's very likely we see a bottom at some point in 2023. And more importantly, it's also likely we see a big rally in bonds at 2023. I'm just not ready to buy bonds, and certainly not ready to buy risk assets ahead of what should be a material repricing in an asset market.
Yeah, and timing these can be really difficult. And I know that so many of you who
But I
came
get
on
paid
last
for it.
year, really, it's painful. And warned that within these bear markets, you can get powerful moves, but it doesn't mean it's over. And to that point, Brent Donnelly's he tweeted something that caught my eye today, saying pain trade day today. GS Most Short fund backed up cross GPY ripping oil down. All the favorite trades are getting smoked today. It sounds like it's still a really tricky market to navigate.
Yeah, well, so I mean, so something we called out in our research earlier this morning, but it's kind of faded, and part of the
Mhm.
reason it faded is because the Fed minutes. Because
Yeah.
again, the markets, there's a lot of liquidity on the sideline, right? We all know that the reverse repo facility balance is north of $2 trillion that's waiting to be put to work at any given time. So there's ample dry powder out there on the sideline to rally risk. The problem is we are waiting as an investor community for the Fed to get the hell out of the way, and the ECB to get the hell out of the way, and the Bank of England to get the hell out of the way, and oh, by the way, for China to get the heck out of the way. We haven't even talked about China yet, but by the way, the PBOC has been tightening to defend yuan, and we're obviously seeing that weigh pretty substantially in Chinese growth, on top of obviously community transmission of COVID. So it's just a very murky picture to be trying to allocate risk, and more importantly, what complicates that picture, particularly for institutional investors, which have mandates and investment committees and ultimately, fiduciary standards to the investments that they make. Asset markets are still pretty richly valued. Not only richly valued relative to their longer term time series, but richly valued relative to the fact that we're now dating our new girlfriend, Terra. We were dating Tina for a long time, and then we kicked her to the curb, and now we're dating Terra, which is there are reasonable alternatives, particularly on the short end of the fixed income space. And as long as there are reasonable alternatives, the cost of capital, the hurdle rate for every trade you make is going to be really much difficult, which keeps the pressure, the selling pressure, the lid over the top of the market.
I like that. I like we have a new acronym that we're going to have to torture ourselves about. I do want to, before we wrap up, I do want to talk about China because you had a chart, I think one more chart that we've got, about the kind of relationship with the US and China. Do you see changes coming to China? I mean, they're tightening, but gosh, one would imagine they'd like to be supporting their economy a little bit more. Is there something we need to be watching on that?
Yeah, the number one thing I'm watching is for any headlines and inclinations that China is going to go big on fiscal stimulus, because there have been these times in modern economic history where China has had the ability to bail out the global economy all by its lonesome. We've seen that in kind of 2008 heading into 2009. We've seen that kind of in 2016 heading into 2017. We saw that kind of in the spring of 2020 as well in terms of the easing that we saw out of the PBOC in conjunction with some of the fiscal stimulus initiatives that they had. But right now, if you look at slide 46, Brian, if you put that slide up, what I'm showing in this chart on the top panel is 3-month SHIBOR as a catch-all for all the different policy measures that the PBOC uses to manage monetary policy in China. They have like an alphabet soup of things that they do on a regular basis. So, trying to track them all is you sort of you lose a lot of sleep trying to track them all. So we use the 3-month SHIBOR as sort of the catch-all because again, most private non-financial sector credit in China is on bank balance sheet, right around 83%. The red line shows the credit impulse, and the dotted line show the inflections to the downside in the credit impulse. Credit impulse, by the way, leads Chinese growth by 1 to 2 quarters, and so we've inflected to the downside going back to this middle part of last year, and have been trending lower since from a credit impulse perspective because again, we're now really starting to tighten to support that yuan. Now, the dollar has gone down a significant amount since, kind of the October highs that is observed. And so ultimately, we're going to start to see the PBOC, kind of, take its foot off the brake a little bit and maybe step on the gas pedal. But again, tapping on the gas pedal versus stepping on the gas pedal, in my opinion, are two very different things. There will be a positive shock to global economic demand associated with the Chinese, the relaxation of zero COVID, starting really in January. We're already starting to see mobility data pick up relative to December. The issue is that positive. There's really multiple issues. I'd say the two biggest issues relative to trying to put capital to work in financial markets is the magnitude and duration of that positive shock going to be enough to overcome all of the incremental policy tightening we're going to get out of the Fed, ECB, maybe even the Bank of Japan this year. And I'm not so sure what the answer to that is. We need to see a lot of stimulus out of China to overcome all those headwinds from a liquidity cycle standpoint. And then two, if China steps on it too hard, do they start to reinflate commodity prices and really put a lot of pressure on global supply chains to the point where we're now dealing with more goods inflation at the same time we have sticky late cycle services inflation and ultimately more employment that's broadly more demand for labor as a function of incremental Chinese demand? I'm not so sure I know the answers yet, but I do know where we're headed by the end of this year, which is a global recession that has yet to be priced in.
Yeah, and that's that sort of seesaw balance that when you're talking about walking that fine line, when you're trying to sort of figure out the implications of a Chinese policy move like that. We're getting a lot of love for your shirt, Darius. Paul saying, "Are you sending us
a closet full of these? Should I start wearing them?"
Sending a subtle message with your shirt that we should be ready in the second quarter, springtime, flowers and growth, green shoots. Anybody remember that? We used to talk about that back in the day. But very seriously,
I got a funny tidbit since it's January. We're having a good time.
Exactly.
When I met my fiance, I met her. We met on like Hinge, and I showed up to the date in January in the city in New York. It's probably like 20 degrees outside in one of these shirts. And then I showed up to the second date on one of these shirts. She thought I had only one shirt for like several months. But the answer is no. I have a closet full of these, and I'm just a swaggy guy.
Swaggy guy. We're seeing another side of Darius. I love that story, and I love that she loved your fashion sense, Darius.
I don't know if she loves it. She just has to eat it.
So I hate to sort of turn the tone, but you're pretty bearish. I mean, if I'm sort of listening to everything you say, this recession, as you just mentioned, not priced in. We're in the 6th inning. I think you mentioned the focus has to be on the labor market, less about goods inflation, more about services, more about a tight labor market. Take the Fed at their word for now. That's going to be where their focus is, and there are imbalances that are going to mean that they are going to continue to be aggressive. And that second phase, that credit cycle phase where we see earnings deterioration, that's still out there. So it's going to be very tough sledding for risk assets, for stocks. And you wouldn't be a buyer of, it's too early to be a buyer of bonds. So this is still a rough environment.
It's still a short risk parity environment from our perspective. I think if you go back to prior to that December 14th Fed pivot, because again, that was a Fed pivot. I haven't heard anybody say it besides me, but if you look at what happened, they basically they shifted the things that they care about, which made them incrementally more hawkish. Everyone was focused on the step down to 25 basis points from 50, or from 75 to 25 to 50 to 25. But the reality is they're going to be doing more 25s than what's currently priced in the market. I think the market has them getting up to 5.25 in terms of the Fed funds rate, ultimately pivoting back to 4.75 by the end of this year. Those two rate cuts aren't coming, so that's 50 basis points there, and maybe it's 5.5 or 5.75. Ultimately, you might get an incremental additional 100 basis points of policy rate tightening by the Fed relative to current market expectations this year, because they've shifted their reaction function. And I'd also like to clarify, you could have gone back to prior to that Fed pivot in December 14th and really thought there was going to be a credible window for risk to really rally and kind of squeeze consensus positionings. That window still exists. I just think it's a lot shorter. And how the window would have worked, which is if the Fed was content to continue anchoring on inflation as the primary driver of its reaction function, and more importantly, had maintained that clear and convincing evidentiary standard, as opposed to upgrading its evidentiary standard to substantially more evidence, which also was part of that pivot as well, we could have gotten to a situation where February 1st was the last rate hike. Mm-hmm. And February 1st, the last rate hike, in the context of the ECB and Bank of England, et cetera, still tightening, you're going to see the dollar get smoked as China reopens, growth picks up, and ultimately consensus short positioning across risk parity type investments would have really gotten squeezed. And it may still happen. I just think that window of time for you to sort of be done with pricing in phase one, the liquidity cycle downturn, and ultimately having to start to price in phase two, the credit cycle downturn, that window has compressed. And that's why I sound so bearish, because again, I think you got to be a cowboy if you really want to bet on that upside risk, that right tail risk in that window. And I just don't think that window is wide enough anymore to really be to be a fiduciary and actually put that type of money to work.
Yeah, it makes sense. And I understand you're calling it a hawkish pivot. They're moving the goalposts is what you're saying.
They did move the goalposts.
They're moving the goalposts and finding a reason and explaining their reason for being hawkish. So if you were pinned on inflation, turn your attention elsewhere, which we're certainly going to do this Friday when we get the jobs report. Darius, it was fantastic to see you as we kick off this new year. Thank you so much. And thanks to all of you for joining us. Andreas will be back tomorrow with George Goncalves. Until then, take care and good luck out there.